Imagine a company that's not just part of an industry, but actively redefining it, changing how we move, live, and connect with our cities. You've got $1,000 and you want explosive growth. Do you chase the usual suspects or find the hungry innovator with a clear path to victory? This isn't just about getting from point A to B, it's a revolution in personal mobility, a digital earthquake shaking transportation to its core. We're talking about a company woven into daily life, synonymous with convenience and speed, with massive expansion plans and a razor-sharp strategy. Stick with me. By the end of this deep dive, you'll know if this is the move to set your portfolio on fire. Hit the like button. Let's get 1,000 likes on this one. Share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Ready to make your money work harder? Let's get down to business. The company I believe could turn your $1,000 into a growth engine? Lyft, ticker symbol LYFT on the NASDAQ. Lyft didn't just join the ride-hailing industry, it helped create it. While Uber grabs headlines, Lyft has quietly built a powerhouse, primed for explosive growth. Why Lyft? Because it's focused. While Uber sprawls into food delivery and freight, Lyft zeroes in on personal mobility. Every new initiative, partnership, and market entry has a bigger impact for Lyft than for its giant rival. The global ride-hailing market is projected to grow at over 16% annually through 2030. Lyft, as North America's #2, is perfectly positioned to ride that wave. Investing in Lyft means betting on a focused, strategic player in one of the fastest-growing industries on the planet. This is your chance to get in on the ground floor of Lyft's next chapter. Let's talk numbers. For years, the story of Lyft was one of burning cash, chasing growth, and fighting to survive in a fiercely competitive market. Every quarter, analysts and investors would scrutinize the company's financials, searching for any sign that the ride-sharing giant could turn the corner. The pressure was relentless, and the skepticism was everywhere. Critics were quick to point out the losses, the mounting expenses, and the seemingly impossible path to profitability. Headlines questioned whether Lyft would ever make money, and business analysts often dismissed the company as a perpetual underdog, overshadowed by its larger rival, Uber. But in 2024, everything changed. Lyft achieved full-year profitability for the very first time, silencing the doubters and proving that its business model could, in fact, deliver real results. This wasn't just a lucky quarter or a one-off event, it was a turning point that redefined what's possible for the company. This isn't a fluke, it's a fundamental shift. Lyft's business model is working and it's reached critical mass. The company has found its stride, balancing growth with operational discipline and building a foundation that can support sustainable success. With $5.8 billion in revenue compared to Uber's $44 billion, Lyft may seem like the smaller player. But that smaller size is actually an opportunity. Every new dollar of revenue has a bigger impact on the bottom line, and there's plenty of room to grow. Lyft's focus on efficiency and targeted expansion means it can adapt quickly and capitalize on new opportunities as they arise. With a $9 billion market cap, Lyft is lean and ready to scale. The company's streamlined operations and renewed focus on profitability have positioned it to widen its profit margins as it grows. Investors are starting to see the potential for significant upside as Lyft leverages its existing platform and explores new revenue streams. Profitability means Lyft can now invest in growth, technology, and partnerships from a position of strength. Instead of scrambling to cut costs or raise emergency funds, the company can focus on innovation, improving the rider and driver experience, expanding into new markets, and forging strategic alliances that will drive future growth. The stock has rebounded from its lows and is now trading above many analyst targets. Wall Street, which once doubted Lyft's ability to survive, is just starting to notice the company's transformation. As more investors recognize the shift, momentum is building, and confidence in Lyft's future is growing. For long-term investors, this is a powerful signal. The market is waking up to Lyft's new, profitable reality. The company's turnaround is more than just a financial milestone. It's a sign that Lyft is entering a new era, one where growth and profitability go hand in hand. Getting in now is still getting in early. The company's transformation is just beginning, and those who recognize the opportunity today could be well positioned for the next phase of growth. Early investors have a chance to ride the wave as Lyft continues to scale and expand its reach. Lyft is no longer just surviving, it's thriving. Drivers, employees, and investors alike are feeling the momentum, and the company's culture is shifting from one of survival to one of ambition and optimism. The company is now playing offense, not defense. With a clear strategy and the financial resources to back it up, Lyft is making bold moves, taking calculated risks, and setting its sights on new horizons. This financial stability is the launchpad for Lyft's next phase. The race is on, and for the first time, Lyft is running with the wind at its back, ready to accelerate into a future defined by growth, innovation, and lasting success. Think Lyft is just a North American story? Think again. While most people associate Lyft with bustling American cities and the familiar pink logo, the company has just made a move that could redefine its entire future, and the future of global mobility. In July 2025, Lyft made headlines by acquiring European ride-hailing company Freenow for $200 million. This wasn't just another business deal, it was a bold leap across the Atlantic, signaling Lyft's intent to become a truly international player in the ride-hailing industry. With this acquisition, Lyft instantly transforms from a regional powerhouse into a global contender. The deal opens the door to Europe's massive, largely untapped market, where millions of potential riders and drivers are waiting for a better mobility solution. Imagine the possibilities as Lyft's technology and brand recognition begin to ripple across cities from Berlin to Barcelona, Paris to Prague. Right now, Freenow serves less than 1% of Europe's personal mobility market. That means there's an enormous runway for growth. Europe's cities are dense, public transit is strong, but the demand for flexible, on-demand transportation is only increasing. Lyft's entry could be the spark that ignites a new era of competition and innovation. By acquiring Freenow, Lyft now has the platform, brand, and operational footprint to supercharge growth across the continent. The company can leverage its expertise in technology, marketing, and logistics to rapidly scale Freenow's presence, improve service quality, and attract both riders and drivers. Instead of spending years and billions of dollars building a European business from scratch, Lyft has bought a ready-made operation. Now it can focus on what it does best: scaling, optimizing, and innovating. This approach allows Lyft to move fast, outpace competitors, and capture market share before others can react. It's a classic case of smart capital allocation, like buying a beautiful mansion and renovating it to your taste, rather than starting from the ground up. Lyft gets the benefit of Freenow's local knowledge, regulatory relationships, and existing customer base, while adding its own technological edge. For investors, this is exactly the kind of bold, forward-thinking strategy that signals global ambition. It shows that Lyft's leadership isn't content with incremental growth. They're swinging for the fences, aiming to capture a share of a market worth tens of billions of dollars. The Freenow acquisition is a clear sign that Lyft's leadership is thinking far ahead, planning not just for the next quarter, but for the next decade. They're positioning the company to be a dominant force in global mobility, not just a regional player. The revenue and profit potential from Europe could be a massive catalyst for Lyft's stock. If the company executes well, this move could unlock new streams of income, diversify its business, and drive long-term shareholder value. This is the kind of story Wall Street loves: visionary leadership, global expansion, and the promise of explosive growth. And you're hearing it here first, before the rest of the market catches on. Lyft isn't content to stay put, it's going global. The Freenow acquisition is just the beginning of a new chapter, one that could reshape the future of transportation, not just in Europe, but around the world. Lyft knows it can't win alone, so it's building a dream team of partners to accelerate growth. The Baidu partnership is a game changer. Together, they're developing autonomous vehicles for Europe, leapfrogging the competition. Baidu brings world-class AI. Lyft brings market access through Freenow. But Lyft's not just betting on the future. Partnerships with MasterCard and DoorDash are driving real revenue now. MasterCard perks boost rider loyalty. DoorDash lets drivers earn on both platforms, making Lyft's network more efficient. Each partnership adds a new lane to Lyft's growth superhighway, expanding reach and making its platform stickier. Lyft is becoming a central hub for modern mobility, not just a ride-hailing app. For investors, this network of allies multiplies growth opportunities and reduces risk. You're not just betting on Lyft, you're betting on an entire ecosystem. That's a powerful team to have on your side. Lyft's partnership with United Airlines is about to take off, literally. Getting to and from the airport is a pain point for millions. By teaming up with United, Lyft becomes the default choice for travelers. Starting in 2026, Lyft's services will be deeply integrated into the United app. Book your flight, schedule your ride, earn miles, all in one tap. This partnership gives Lyft access to a massive loyal customer base and elevates its brand. Airport rides are longer and more profitable, boosting Lyft's revenue per rider. For investors, this is a clear, predictable growth catalyst. It's not speculation, it's a signed, sealed deal set to add a new layer of growth. The United partnership signals to the market that Lyft is a serious, reliable corporate partner. This could open doors to even more lucrative deals. The roadmap for future success is clear, and it's taking flight. In business, everyone's eyes are on the market leader. The headlines, the hype, the glory, they all go to the number one. But what if the real opportunity lies just behind the leader? Sometimes, the biggest returns come from betting on the hungry number two, the challenger with something to prove and everything to gain. Take the ride-sharing market. Uber dominates with a massive 75% of the US market, while Lyft holds a solid 25%. On the surface, it might seem like Uber is the only game in town, but look closer, and you'll see a different story unfolding. Lyft's underdog status is actually its greatest strength. Being number 2 means you're always pushing, always innovating, and never complacent. The pressure to catch up fuels creativity and resilience. As the smaller player, Lyft can move faster, pivot quickly, and take risks that a giant like Uber can't. It's like being a speedboat racing alongside a cruise ship, agile, responsive, and ready to seize new opportunities. This nimbleness gives Lyft a longer runway for growth and innovation. Consider the numbers. For Uber to double its revenue, it needs to find an extra $44 billion, a staggering leap that gets harder as you grow. The law of large numbers starts to work against you. For Lyft, the bar is much lower. Doubling revenue means adding just $5.80 billion, a far more achievable goal. Every new rider, every new city, and every point of market share makes a real impact. That's why every percentage point Lyft gains in market share moves the needle in a big way for investors. The growth potential is exponential compared to the leader. Despite fierce competition, Lyft has proven it can compete and operate profitably, even in Uber's shadow. It's built a loyal customer base and a strong brand identity, carving out its own space in the market. Yet the market often overlooks and undervalues number 2 players. This creates a unique window of opportunity for savvy investors who can spot potential before the crowd catches on. The valuation gap between Uber and Lyft is a massive opening. While Uber commands a premium, Lyft trades at a discount, despite its growth prospects and proven resilience. While the world is busy watching the king, you can quietly accumulate shares in the prince, positioning yourself for outsized returns if the underdog surprises the market. Lyft's resilience, smart strategy, and ability to adapt make it a compelling growth opportunity. It's not just surviving, it's thriving, and that's what makes it so attractive for forward-thinking investors. In the race for returns, the upside is simply greater when you bet on the underdog. Don't overlook number 2. Sometimes that's where the real win is waiting. While the battle rages in megacities, Lyft is targeting fast-growing, often overlooked U.S. cities like Indianapolis and Nashville. These cities are economic engines with less entrenched competition. Growth here is more profitable and sustainable. By becoming the leading ride-hailing service in these markets, Lyft builds loyal customer bases and dense driver networks. It's a classic land and expand strategy: secure secondary markets, build a base, and keep expanding. This approach diversifies Lyft's revenue, making it less dependent on a few major cities and more resilient to regulatory changes. For investors, this smart, risk-mitigating strategy is music to your ears. Lyft isn't just growing fast, it's growing smart. The company is blazing its own trail through America's heartland. This long-term play will pay dividends for years to come. Lyft is building a broad, stable foundation for future growth. Wall Street analysts mostly rate Lyft as a hold. They're cautious, looking at the past, not the future. But that's your opportunity. The greatest money is made by being ahead of the consensus. Analysts haven't fully recognized Lyft's transformation profitability. The Freenow acquisition and powerful partnerships are just starting to play out. The stock isn't yet priced for global expansion or the full impact of these deals. When analysts finally upgrade, the easy money will be gone. Investing is about buying a company's future, not its past. The current hold ratings are a gift, a window of opportunity before the herd arrives. Don't let their caution hold you back. The future of Lyft is bright, and the time to act is now. Seize the moment. There you have it. The case for Lyft as the ultimate growth stock for your $1,000. We've covered profitability, global expansion, powerhouse partnerships, and smart U.S. strategy. Now it's time for action. If you want to level up your investing, check out our Value Stocks Investing Master Course, link in the description. For deeper insights and real-time picks, join our exclusive Patreon community. Drop your thoughts in the comments. What's the biggest reason you would or wouldn't invest in Lyft right now? Like, share, and subscribe for more hard-hitting stock analysis. This is your home for making money in the market. Thanks for watching. See you on the next one.